Greetings and thank you for joining us at FutureMoneyTrends.com. I'm here with Brian Lundeen. He's the editor of the Gold newsletter. He's also the founder of Jefferson Companies. If you've been to the New Orleans investment conference, which many people have, I talk to people all the time who it's an annual ritual to go to this show. And my goodness, Brian, how long has that show been running now?
Well, we just celebrated our 40th anniversary.
That's amazing. So,
yeah.
And this last show, of course, we want to talk to you. First of all, thank you so much for joining us today.
Glad to be here, Dan.
Brian, I know Alan Greenspan spoke publicly, but I know you probably had some private time with him too. I mean, you guys invited him down to the Lion's Den. Essentially, you know, he is this Keynesian guy. Although he had a nice background where it was like libertarian gold. 30, 40 years ago. If is there anything you can shed with us on your conversations with Greenspan about the current dilemma the Fed is in?
Yeah, that was a real complicated story, and he is a complicated man, and I really thought it was important to bring him to the conference this year. Back to the conference, he had spoken before he gained the Fed chairmanship many years ago. And he was one of the most radical and eloquent gold bugs ever in the 1960s and early 70s. And so, it was like I wanted to get him there to say, what happened? And I think what he's summing up everything he said. Of course, he speaks in green speak, so you have to kind of interpret it and ferret out what he really means. But his whole explanation of his supposed turning his back on gold and free markets and libertarianism was that he was in the position of financing the government's spending, and if he wasn't going to do that, the blame in essence lay with Congress and the presidential administrations, with Washington itself. If they spent the money, then it was the job of the Federal Reserve to finance that spending. And so he was merely doing his job, and he was working within the system, not changing his core beliefs. He was working within the system, and felt that was the only way to really advance his ideas on the margin, at least, was to stay within the system. Because if he declined to finance the spending at any point in time, there would have been a new Fed chairman in that office within a week or so. So better to have him than someone else. So this may be all rationalization, but I thought what was important was that he returned to his roots at the conference, in his presentations, and in our private discussions as a real gold bug, and a fairly radical gold bug. And importantly, he noted in his public presentation that the excess banking reserves, which have been a big focus of what I've been talking about in Gold Newsletter for a number of years, but these excess banking reserves are overhanging the economy, and it's tinder, he put it, that has yet to be lit, and that eventually it would, and with the expected reaction and symptoms of rising retail price inflation once that money actually hits the economy. So he really is kind of in our camp and recognizes the same problems that we all recognize.
Now, when he hears a person like you talk about hyperinflation, or if he saw some of the other speakers, the threat, the risk of America having hyperinflation, what is his view of it? Does he believe it's possible? Or I think it was Kyle Bass or somebody had either dinner or something with Bernanke, and Bernanke was literally like, no, that is impossible. Like, it can't happen. Is Greenspan open to the idea of a major currency risk and the market losing faith in the currency, or does he think ultimately the dollar is safe because it's backed by the full faith of the U.S. government along with its nuclear warheads?
Well, I didn't ask him specifically about hyperinflation, and I frankly I wouldn't ask him about that, because I think his response would be in the negative immediately, because it hurts someone of his stature's credibility to talk about hyperinflation, when in fact all they really need to do is talk about higher inflation and significantly higher inflation. And in fact, he did. He talked about the gold price while not giving us specific price targets. We asked him where he thought the gold price would be in 5 years, and he said measurably higher.
That's very Greenspanish.
Very Greenspanish and very measured, literally. But in private conversation, I asked him about the outstanding debts and how my thesis that the debt load in the U.S. and in Western economies have gotten so great that there has to be some monetary depreciation. Specifically, he said that the era of quantitative easing and zero interest rate policies by the Fed, that we really cannot exit this without some significant market event. And by that, I interpret it being either a stock market crash or a prolonged recession, which would then engender another round of monetary reflation by the Fed. So he thinks something big is going to happen, that we cannot get out of this era of money printing without some repercussions, and pretty severe ones, that gold will benefit from.
Yeah, that kind of leads us into something you've been covering, is the currency war. So could the event be this devaluation that's going on around the world, where it ultimately leads to some type of currency event?
Yes, I think that could happen. Now, I specifically asked him about that. At the time of the conference in late October, we were just beginning to see that develop, that kind of currency war develop. And his view was that, and primarily it was due to, the big issue at the time was Europe. And his point was that Europe itself represents only about 15% of U.S. trade, and it also represents a small part of U.S. GDP, so that U.S. could withstand to some degree economic problems with its trading partners. But I think what it's important to note is that what we're seeing, particularly with the Federal Reserve minutes released just a day or so ago, was that the Federal Reserve itself, the FOMC, is concerned about events in Europe and, by extension, these currency wars and the effect that they will have on the U.S. economy. So whether there is a real threat to the U.S. economy or a significant threat to the U.S. economy by the growing weakness in Western economies and the growing weakness in its currencies, the important point is whether the Fed perceives that there is a risk. And I think they do. And I think it's a much more dovish Fed now than there was last year, obviously. And I think that rate hikes will be postponed until 2016.
In a few email exchanges we recently had, you had said most people are aware, at least in the gold community, that there is a growing demand around the world for physical gold, a significant growing demand. But you had mentioned that Chinese gold demand might be even greater than we think it is. If you could just kind of expand on that and let me know what you meant.
Yeah, the Chinese gold demand, the most direct and accurate proxy we have for Chinese domestic gold demand are deliveries from the Shanghai Gold Exchange. And these deliveries, or these withdrawals from that exchange, within China are running some 800 tons greater than what the World Gold Council is saying it represents domestic Chinese gold demand. And they've tried to massage their numbers and rationalize the differences away. But the bottom line is that they're reporting that Chinese gold demand was off by some 50% last year, when in actuality it was off by only about 4% from 2013's record levels. And 2013 represented a tremendous surge in Chinese demand, far above previous levels. So what we're seeing is that gold buying in China has not only ramped up to a new record pace, far exceeding anything we've seen before, but it's been maintaining that pace for about 2 years now. And in fact, the run rate so far this year would break any records from 2013 or 2014 by a considerable margin. So this is something going on in China, and I personally think it has something to do with an official policy regarding the currency and potential gold backing of the currency, some longer-term strategy, some proxy, if you will, for the economic power going from west to east, as we see the gold flows going from west to east. So it's something that's not going to end soon, and it is currently absorbing the vast majority of all newly mined gold in the world.
Now, in an environment where everyone's trying to devalue the currency, where the biggest loser is the biggest winner when it comes to devaluation,
right,
what happens to everybody who's second, third, fourth, fifth in that race? I mean, is it just going to continue to, or is the devaluation going to accelerate? If you're not the winner, I guess you just got to keep devaluing. And right now, the U.S. looks like it's taken a major blow in the last 6 months.
Yeah, it's a race to the bottom of a hill, and you have no economic advantage unless you're winning the race. So the question really is, how long in this environment can the U.S. stand aside and let the dollar soar in value relative to its trading partners? And the end has to come at some point, if not from the real-world effects in the economy, but from the sheer lobbying efforts that will be brought upon Washington and the U.S. Treasury from the multinational corporations that are suffering. So we'll see some repercussions from this, and it will have to end. If you look at a chart of the U.S. dollar index, it's gone nearly parabolic over the last few months. And in any market that is so one-sided, that is accelerating so rapidly, will end. That trend will end at some point. It's just a question of when. And with so many dollar bulls on that side of the boat, on that side of the trade, it will most likely end in a fairly violent fashion.
Do you think the dollar is nearing a top because of that parabolic move? And then kind of on a I guess part of the question would be too on gold side. I mean, here you have gold up in other currencies, the dollar's up in other currencies, and gold is not really down against the dollar for the past several months. I know we've had a pullback here, but it's not making any new lows or anything. So I'm just wondering if perhaps gold is showing its bottom and the dollar is showing its top.
Yes, in a very general sense, you can say that, and frankly should be saying that. The thing you can't do is try and time when the exact tops will be made. We've been burnt a number of times in gold in particular, saying this is the bottom. We thought that 1180 level was the floor for so long. Then in early November, it burst through that floor down till around 1140. So I don't know that you can say this is definitely the bottom, and I think you're kind of tempting disaster if you say that. But what we can say, this is around the bottom, that if prices go much lower, then we're going to be lower than the all-in cost of production, the average all-in cost of production. And not saying that gold can't go lower than its cost of production, but it can't go much lower for very long. So your downside risk is limited, and there are just so many factors out there that are potential time bombs that could launch the price of gold, that it really makes sense to be accumulating at this level, at these levels, at what is almost assuredly near the lows in gold.
That's a really good point. I mean, considering that a lot of the miners aren't making a profit, I mean, let's be real. At this point, at 1,200, our downside, I would guess, is about 20%, wouldn't you say?
Yeah, that's exactly about where I put it. And you also look at the fact that, well, on the upside, you have a couple of 100% potential there. And if you're in the miners, you have, or miners, juniors, developers, you have the potential for, 10 or 20 baggers from this if we get the same kind of market that we got, around 2005, which, as I said, for a number of reasons, seems to be a very realistic possibility over the next few years.
Brian, I want to move into energy markets. They've been totally just shocked with this recent collapse in oil. But before I get into oil, I wanted to talk to you about Japan announcing that they're going to restart their nuclear power plants. You know, I am very excited about the uranium story. You've pretty much laid out the case of this. There's a major supply deficit for mines versus how much is being consumed. And I love what you said in your email to me, that it was the trend for nuclear is irrefutable and irreversible. And I think a lot of energy investors are getting excited because I think uranium, the spot price, at least it looks like we're in an uptrend, and we're coming off this really low price in September of 28, and now we're at 38 a pound. Do you think this is the time for uranium stocks?
You know, it is an irrefutable and irreversible story. The turnaround is not necessarily imminent, and we really, and it's been like that for the last few years. If you look at the demand trends for uranium and you look at the supply trends, at some point you know that those lines will cross, and that uranium prices will begin a fairly strong rally. It's just been a question of when. Now we're starting to see some signs that change, that rally in uranium prices may actually be imminent. Not only do we have Japan restarting reactors after Fukushima, we have other events that are starting to happen. Well, first off, we had a 40% rise in the price of uranium in the fall. That was really unexpected, and it just kind of happened organically, and we're still up about 35% from those lows. And just recently, over the last few days, we saw a couple of events at Olympic Dam in Australia and at Rio Tinto's Rossing mine in Namibia that are going to significantly affect production from those two projects. And those two events alone could be kind of a starting gun for this rally in uranium. And we'll see that over the next couple of weeks if indeed that's going to have an effect on the price.
The last time we had spoken, you had recommended one of Amir Adnani's companies, Uranium Energy Corp. Is that still a buy? I mean, has the fundamentals for that company changed in any way, or is this still a good place for people to look if they start researching?
It's a great place. You know, there are a lot of I do cover a number of uranium stories in Gold Newsletter, but I don't think there's any one that's more leveraged or immediately leveraged to the price of uranium than UEC, and that's because it's actually in production. You know, I had a conversation with Amir back when UEC was a private company, and really just an idea in his head. And he was bringing it public. They were going to develop uranium projects, and he saw a big boom in uranium coming. That boom came and went in uranium, and we saw just hundreds of uranium plays develop in the junior mining sector. And then the boom ended, and they virtually all went away. But it's a real testament to Amir and his managerial abilities and his dedication and his vision that UEC stayed, not only survived, but thrived and progressed and actually went into production. And they're one of the few of those companies that actually made it to production. And the difference is that they can ramp up production now in an immediate reaction to any rise in the uranium price. So there really is no other company out there that I see that is as levered to uranium prices and a rising uranium prices as UEC.
You know, you talk to a lot of CEOs and executives of this of the mining sector, and I know you've been in the business for a long time. You know, my impression of Amir is in any business, whether I'm dealing with realtors when I'm buying properties or loan officers or whatever the business is specifically mining sectors. I've noticed Amir is there's something unique about him, and I was wondering if you had any thoughts on him. I did not know that you guys had went all the way back to before he started UEC, so just watching, being in this industry for so long and watching him grow. Do you think Amir is only going to be one of those guys where he's kind of like a Ross Beatty, kind of a legend in the industry?
Oh, absolutely, absolutely. I mean, he's a good ways there. He's just he's smart. He's a great manager, but he's also relentless. And let me tell you, for UEC to get into production during the early stages of the uranium boom and then through the years of the crash in uranium prices, for him to still bring UEC into production, and not only that, but have a thick and viable pipeline of projects in development that can either go into production in the very near term or will eventually. That is an amazing feat for someone to accomplish during that kind of period of malaise in uranium prices. So, yeah, I think he's proven that, and he's not the kind of guy that you want to bet against in any venture, because he's going to make something a success, if by nothing else than sheer force of will.
The word relentless, I'm like, that's the word I was looking for. Well, hey, let's move on to oil. It's one that directly affects everyone as a consumer. I'm sure people are taking pictures and selfies with gas prices. I just moved to Texas from California, and here in Texas, I took a picture of my daughter next to a gas sign that said $1.55. It was at Costco, and of course I sent it to all my friends living in the Communist Republic of California, where they've got
right.
55 cents baked into the cake even before the gas price or the federal tax. But gas prices low, it feels like 10 years ago. I mean, it's like $25 to fill up my Yukon. But how does this affect the U.S. economy?
Well, we're just seeing the effects start to ripple in through the employment numbers now, or will over the next few weeks and month or two. I think that the January jobs number was a pleasant surprise to the markets, but I think there's going to be a real. I don't think February is going to be a very good number. We'll see that in a couple of weeks. There are repercussions for the economy. Obviously, I think though that it's largely going to be a wash, the positives versus the negatives. Some of the other issues that we'll see though is that this is going to be a long-term effect on the U.S. economy. What's happening right now is that this production cannot be shut off. This high production from the U.S. can't be shut off just by turning a spigot. It's still has this momentum. It's still coming out, and it's not finding a market for the oil right now. The storage facilities in Cushing, Oklahoma, are just about filled to the brim.
Wow!
Oil is already going into these ships, these very large crude carrier ships offshore, and I think you're going to see more and more of that as the term structures turn more and more bearish. So, what the implications of that is that once we do see a turnaround in the market, it has to eat through all of this supply that has kind of sloshed into every possible storage facility and is there waiting to meet any increase in demand. So it just lengthens the term of the bottom, and I think we're going to have low oil prices for a good while.
Well, that's good news, but Texas, North Dakota, I mean, these two states, especially Texas, are driving the entire U.S. economy when it comes to wage increases. And, being here in Texas, I mean, I don't know. It's rare when you actually meet a Texan. It's everybody's from California and New York and Michigan. I mean, they're just it's turning into like this massive migration of people into Texas. And do you think this is ultimately going to put Texas into recession, which will take the U.S. into recession, right?
Yeah, I don't know if it'll be a recession, but it's going to be a lot of damage for not just Texas, but the U.S. at large. I mean, Texas was responsible, I believe, for the majority of all new job creation over the last 5 years or so in the U.S. Mm-hmm. So, yeah, it will have, as I say, it will have an effect on the employment numbers. And, by extension, the Fed keeps repeating that they're data dependent. And what they're really looking at are the employment numbers. And, we're going to have tens of thousands of oil field workers that are starting to hit the unemployment rolls over the next month or two. And that's going to have a serious effect. And I don't know that effect will be counterbalanced by the employment the added money in consumers' pockets from lower gas prices.
Well, it hopefully not, because Texas, it's got such a great story here, this state, and the people are so well, these are good jobs, I guess. These are really good jobs, so I'd hate to see that happen. But Brian, what right now is like the ultimate opportunity? I mean, I'm looking at TSX Venture chart right now, like for the last 15 years. I mean, this thing is, I mean, if you ever want to buy low, this is it. What opportunities right now are you guys seeing for your gold letter? Not you don't have to mention the stock specifically, but if you'd like to let us know if somebody was to subscribe to your letter right now, I mean, it seems like they'd be buying the bottom, and I know you only pick the best companies. So what are some opportunities you guys are seeing right now?
Well, I think companies that have established resources, whether it's in the form of an economic study, a PEA, or a pre-feasibility, or even a feasibility study, or whether it's just a drilled-off resource that you, as an experienced investor, can kind of look at and say, yeah, they have assets, they have resources, viable economic resources in the ground. These are companies that you can buy for really pennies on the dollar right now, and they offer the same degree of upside potential as you would typically expect from a drill hole play. I mean, you can get a company like Caminac Gold, which is selling for under $1, and peaked after its discovery of the Coffee Project and started getting good drill results, peaked at around over $4 a share. So you can buy companies that aren't going away, aren't going to disappear, that have money in the bank, have millions of ounces of gold in the ground, that have the potential to quadruple your money with a new rally in the gold price like we think we're going to see.
Mm-hmm. Do you think we're going to see a gold rally in 2015?
I'm not that confident of it, frankly, right now. I was a bit cautious when we had that nice surge in late January in the gold price and mid to late January. Mm-hmm. But I cautioned our readers that we had seen the same thing in 2013, where we got up to the high 1300s and then went progressively down for the rest of the year. I really think that we need to get something close to $1,350 to $1,400 in gold before we can say that all of these economic forces out here that we believe are going to be bullish factors for gold over the long term are really beginning to have an impact. And really, there's no reason or need for anyone to time it that closely. We know that this is real long-term value. There are bargains out there that should be bought right now and held on to with a 2 to 3 to 5 year time horizon, with great confidence that your downside risk is minimal and your upside risk over that time frame is really quite extraordinary.
Yeah, no, it's a very exciting time to be a gold investor. Brian, thank you so much for joining us. What is the best website for people to go to if they want to subscribe to your letter?
Goldnewsletter.com.
All right, goldnewsletter.com.
Very simply.
Everybody should check out the New Orleans Investment Conference. All the big names show up to this show every single year. The headliners and the undercards, all great guests. It's some of the people who were there at this last one. Greenspan, you had Rick Rule, Stansberry. Any other big names that you want to mention?
Peter Schiff, Mark Faber, really all the big names. And it's an incredible opportunity not only to be able to see the best minds in the industry and really to mingle with them in the hallways and in the exhibit hall, but also to meet your fellow investors. The people that attend this event have kind of self-selected themselves or defined themselves as the smartest investors out there, and they are. They're very successful investors and business people, and I get some of my best ideas from just roaming the halls and talking to people.
That's awesome. Brian, thank you again so much for your time. We appreciate it. You have a great week.
You too, Daniel. Thanks so much.